Hi everyone, Bill Lethman here for MoneyEvolution.com. In today's video, I'm going to be talking about 3 big retirement tax mistakes. So this video is part of a series that I'm putting together that's going to help you to create your own tax plan for retirement. In fact, if you've watched any of my other videos, you might have heard me talk about what I call the 7 core elements of retirement planning. Well, creating your tax plan is one of those 7 core elements, and maybe one of the most important of those elements as well. So let's dive right in. So retirement mistake number 1 is contributing too much to traditional retirement accounts. I think this is a very common one as well. So we talk about the 3 primary buckets for retirement savings, and traditional accounts have been kind of the go-to plan. It's basically where if you're contributing money to a 401k plan, that money comes right out of your paycheck before it's taxed at all, and then you get tax-deferred growth on that money until hopefully retirement, when you start taking that money out, and then you pay taxes later. Well, I think what oftentimes happens is that people end up with maybe too much money in those accounts, and they don't realize that they might not only be in maybe just the same tax bracket in retirement that they were while they're working, but oftentimes we find some people end up in a higher tax bracket in retirement. In fact, there's a lot of justification right now with what's going on. Taxes possibly going up. You know, we're in a very low tax rate environment right now, especially with the Tax Cuts and Jobs Act that went into effect in January of 2018, earlier this year, and based on past history where tax rates have been. So a lot of us believe that tax rates could be higher in the future. So pay attention to how much money you've got in those traditional accounts, and it also really takes away from some of the flexibility in retirement as well. If you know, every time you want to take money out to go do something, you've got to pay taxes on that money. You know, being careful not to push you into a higher tax bracket. Mistake number 2 is having money saved for retirement in a non-retirement account. So this is another fairly common one as well. People might have thought that they exhausted their resources and maybe tapped out their 401k plan, maybe don't think they qualify for a Roth account. And so this money starts building up in these non-retirement accounts. Now, it's very good to have an emergency fund. I'm definitely a big proponent of that. But if the money is intended for retirement, you want to be very careful about having too much money in those accounts, because again, you're going to have to pay taxes on those gains, interest, and dividends. Everything that that account makes during the year, you're going to have to pay taxes on that. And those account balances are never going to grow to as large of an amount as the tax-deferred accounts, or in the case of a Roth, a tax-free account, you know, where you've got to pay, where you've got that tax advantage going for you there. So look at your non-retirement accounts and how much money you have there. And then the final mistake is waiting too long to take withdrawals. This is another fairly common one. So let's imagine that somebody retires at age 62. One of the very common things to do is immediately say, hey, I'm eligible for Social Security. I'm going to turn on my Social Security benefits right now because I want to get those while I can. And that helps to supplement their income. And what ends up happening is they end up delaying, or at least reducing, the amount that they're taking from those retirement accounts and pushing those further and further out into the future. Oftentimes, by the time you hit 70 years old and now you're forced to start taking those distributions for what the IRS calls your required minimum distributions, that could push you up into a higher tax bracket. One of the things that we oftentimes see when we do our financial plans is we see what we call the low tax years. And depending on when you retire, when you start collecting Social Security, you might find that there's periods of time where your tax rate is going to be a little bit lower than at other times potentially in your retirement. So we can do a couple of things there. Number 1 is we can maybe accelerate some of the withdrawals from those retirement accounts, maybe just to live off of and maybe have some fun while you're young and you've got the ability to do that. Or we can look at maybe doing some conversions where we can take advantage of those low tax years and take some money from traditional accounts and move it over to Roth accounts as part of a tax strategy. So those are just a couple of the things, 3 big mistakes that we see happen all the time. We put together a case study where we're going to walk through what I have as a 5-step action plan using some data and using some examples there of how you might be able to save taxes for your situation. So right below this video, we'll put a link where you can access that case study. And if you like the video here today, don't forget to hit that like or subscribe button. And if you have friends you think can benefit from some of the stuff we're doing here as well, hit that share button. We'll try to get the word out there and help people with some of these tax planning issues. So with that, have a great day, and I'll look forward to seeing you in my next video.